Hello, my name is Alice Kaneya. I'm a CPA and the owner of Gold Accounting Tax. We specialize in real estate accounting and tax. Today, I'm going to be covering 1031 exchange. 1031 of the Internal Revenue Code provides a strategic method of deferring capital gain or recapture tax from sale of real property. This is done through completing a like-kind exchange or a 1031 exchange. In a 1031 exchange, the owner will sell real property that has been held for investment or used in trade or business. The seller will then use the proceeds from the sale of their property to acquire like-kind replacement property of equal or greater value. There are two types of 1031 exchanges. We have the simultaneous exchange. It's least common and hardly used. It was used in the early days, and it required actual swapping of deeds to ensure simultaneous closing of the relinquished and replacement properties. It had limited options because you'd only swap with an investor interested in swapping with the exchanger. We have the second one that is used currently is the deferred exchange. It offers the exchanger more freedom to complete the sale and acquire a property. One can use different parties. It gives you an extensive inventory of investment options. You have 45 days to identify the exchange and 180 days to complete the exchange. With a delayed exchange, there's a timeline. So day 1, closing relinquished property. Day 2 to day 44 is the identification period. Day 45 is the deadline to identify the property or properties. Day 46 to 179, it's the days required to pursue acquisition of candidate replacement property or properties. And then day 180 is the deadline to close the exchange. For you to do a 1031 exchange, you need a qualified intermediary who's also called a 1031 exchange accommodator or a facilitator to ensure the exchange is completed within the 1031 exchange regulations. A qualified intermediary is an independent entity that is not the investor, is not an agent of the investor, or a related party of the investor. The primary function of the qualified intermediary is to restrict the investor's access to the sale proceeds after the sale of the relinquished property. Normally, taxpayers are required to pay taxes on any income received in any given year. To delay paying taxes on one's income, the taxpayer must defer receipt of that income by avoiding both actual receipt and constructive receipt of that income. Actual receipt of income is the taxpayer directly receiving the income, and constructive receipt is income that is not directly paid but placed under the taxpayer's control for them to access, administer, or distribute as they determine. The safe harbor rules, as listed in section 1.103, require the investor to use a qualified intermediary to act as an escrow holder of the funds. The 1031 exchange process. To properly complete the 1031 exchange, the investor must meet two deadlines: the identification period deadline and the exchange period deadline. To meet the identification period deadline, an investor must identify a list of potential replacement properties and provide that list to their qualified intermediary at or before midnight of the 45th calendar day after the close of the relinquished property sale transaction. And with the exchange period deadline, the investor must complete the acquisition transaction of the replacement property or properties on or before the earlier of midnight on the 180th calendar day after the close of the relinquished property sale transaction, or the due date of their federal income tax for the year in which the relinquished property was sold. There are specific requirements for identifying and acquiring potential like-kind replacement properties in 1031 exchanges. Many 1031 exchange investors cannot identify with certainty their one specific replacement property within the first 45 days after the sale of their relinquished property. The IRS allows certain regulation for investors to identify multiple potential replacement properties. The first one is 3 properties rule. You can identify a maximum of 3 potential like-kind replacement properties regardless of the fair market value of those properties. The second rule is the 200% of fair market value rule. You can identify an unlimited number of like-kind replacement properties as long as the total fair market value does not exceed 200% of the net sales value of the relinquished property or properties. And the last one is the 95% rule. You can identify an unlimited number of potential like-kind replacement properties with unlimited aggregate fair market value as long as you actually acquire and close on 95% of the value identified. So it's worth noting that an extension of your tax return due date does not allow an extension of your exchange period beyond the 180 days. Also, 1031 exchange deadlines are based on calendar days, no exception for weekends or holidays. A failure to meet either of these deadlines could result in an invalid exchange, requiring the investor to pay taxes owed on the capital gain. I'm going to have a follow-up video explaining the advantages and the tax benefits of a 1031 exchange. So if you have any questions, feel free to reach out. My email is alice@goldaccountingtax.